So hello everyone, welcome to the plenary lunch for the 2024 ABA May tax meeting. My name is Scott Michael and I am the current chair of the section of taxation. I hope everyone is having a great meeting. We are so pleased to have so many people attending this meeting. We had 1,900 registrants for this meeting, which is a fabulous number and brings us back to pre-pandemic attendance. We also want to welcome the 400 attendees who are representatives of the United States government, the IRS, the Treasury Department, and elsewhere in the government, which is just a phenomenal showing for our government friends. I want to give special thank you to the meeting's diamond sponsors, who are Haynes and Boone, Castellanets, and tax analysts. They make this meeting possible, and their support is invaluable. I also want to recognize Thomson Reuters and the educational affiliate of the tax lawyer, the Northwestern Graduate Tax Program, for their long-term support of the section. And as an undergraduate alum of Northwestern, I will say, hail to purple, hail to white. So before we move on to our awards and our keynote panel, I have a few announcements. Our fall 2024 tax meeting will be fully virtual this year again, from September 23rd to 27th, 2024. This virtual format allows for more of our section members and more of our government representatives and other guests to participate and benefit from our CLE programming and our networking and other programming. So we hope the flexibility of this virtual meeting will continue to draw in new attendees and new members. Please help us spread the word about this meeting. We will be back in person for the 2025 mid-year tax meeting in Los Angeles, California at the Marriott LA Live. Please note, we have changed the date of this meeting from what it was originally slotted for. We have done this to ease the planning process and to avoid conflicts with the winter holidays. So the meeting will now take place February 19th through 21st, February 19th through 21st, 2025. And if you look at your calendars, you will notice that this is a Wednesday through Friday meeting, which we're going to experiment with and see how it goes. But the timing and the planning of the meeting are such that most attendees will be able to get even back to the East Coast on Friday and have their weekends. So we're very excited to try this new format, and we look forward to seeing all of you there. I would now like to acknowledge some of our special guests at this luncheon. First of all, we are thrilled to have our two classes of the Loretta Collins Argret Fellowships with us today. You can see their names on the screen, and I would like to ask all of our Argret Fellowships to stand and be recognized by the group. We are accepting applications for the third class of Argret Fellows. Those applications are due June 30th, so right around the corner. The 3-year fellowship covers section meeting registration, lodging and travel, and membership in the section. So get your applications in and help us spread the word. We are just delighted with the Argret Fellows are here, and we are so excited at the progress the program has made over the last couple of years. I would also like to recognize our Christine Brunswick Fellows. Hannah and Mohit, who you see on the screen, are either of you here? If so, please stand so we can recognize you. They are recent law school graduates working in nonprofit organizations focusing on public interest tax law for a 2-year period. They will be joined by 2 new fellows in September. We are grateful for their hard work. I would also like to welcome our 2023 through 2025 Tax Analyst Public Service Fellow, Leslie McLean. Leslie, are you here? Bravo. Leslie does extraordinary work in the Southwest with indigent taxpayers, and we honor her efforts. And we are also immensely grateful to Tax Analyst for their sponsorship of this incredibly important fellowship. We are still accepting and reviewing applications for the 2024 through 2026 Tax Analyst Public Service Fellow. The fellowship is similar to the Brunswick Fellowship, but geared toward more experienced attorneys. And if you would like to learn more about this fellowship, please check the section's website or contact Meg Newman on the section staff. And finally, I would like to welcome our 2023 and to 2024 John S. Nolan Fellows, whose names you can see on the screen, and to announce and congratulate the 2024-25 class of Nolan Fellows who will start in the fall. The Nolan Fellowship recognizes our up-and-coming section leaders, and this year the selection committee chose these 6 outstanding contributors to the section's work, and I'll read their names. Jonathan Amatrano, Garrett Broder, Blair Linka, Billy Min, Daniel Strickland, and Patrick Thomas. So if all of our Nolan Fellows would stand, we would like to recognize and express our appreciation for you. Now on to business. The first item of business is that I have the honor of presenting the 2024 Janet Spragens Pro Bono Award. This award was established in 2002 to recognize one or more individuals or organizations for outstanding and sustained achievements in pro bono activities in the tax law, which is such an important part of our section's mission. This year, the committee selected Guinevere Moore, and I could not be more thrilled to present her with this award. Many of you will be familiar with Gwen's many and varied pro bono activities over the years, as she has been steadfastly committed to sharing her time and talents since the start of her career. In addition to many hours spent representing individual taxpayers through the Calendar Call program and other pro bono referral networks, Gwen has organized training for other professionals to participate in the Calendar Call. She will always take on a pro bono matter, even when her firm is not accepting new clients, and even when she is in the middle of a substantial criminal trial, the last of which, by the way, she obtained a complete acquittal on all charges. Gwen has been deeply involved in larger litigation projects to promote social justice. In Doe versus Trump, she was a crucial part of a team litigating a class action case on behalf of U.S. citizens married to non-U.S. citizens who were ineligible for COVID relief under the CARES Act. In 2022, she represented the Center for Taxpayer Rights as amicus curiae before the Supreme Court in Bittner versus United States. This dispute addressed the statutory interpretation of penalty amounts under Section 5321 of Title 31, known to many of us as the F-bar penalty. In ruling for the taxpayer, the Supreme Court cited Gwen's brief. She has been an active member of the tax section since she was admitted to the bar. She served as chair of the Standards of Tax Practice Committee, where she was very involved on comments on the 2014 revisions to Circular 230. She also founded the Women's Networking Breakfast at the Criminal Tax Fraud and Tax Controversy Institute in Las Vegas, and as a council member now is an inaugural leader of our very exciting Live Well, Lawyer Well program. Gwen is a devoted mentor to a new generation of lawyers and social justice advocates. As her nomination letter says, she is never bashful about enlisting others to fight for a just cause and encouraging others' participation and involvement to facilitate a necessary change. Her conviction and belief is contagious, and her ability to rally the troops to create a strength in numbers is nothing but effective. It is now my honor to present the 2024 Janet Spragens Pro Bono Award to Gwen Moore. The floor is yours.
Thank you so much, Scott, for that amazing introduction. I am beyond honored and incredibly humbled. If any of you have looked at the past recipients of this award, it is astounding to think that I could ever join such an amazing group of people who honestly are my heroes. And this award I accept on behalf of everyone at Moore Tax Law Group, and in particular my partner, Jana Ziering, and everybody else from the firm who's here, Cheyenne, Ajay, Aaron. Every pro bono case that we take is a team effort, regardless of who works on that case, because whenever we take something on like this, as you all know, it affects everyone in the firm. I wanted to say just a couple things briefly. I was raised not to talk about the charitable things that you do and the money that you give, and I'm going to break that rule today. I'm going to break it very firmly because I want to ask everybody here to join me in charitable works and charitable giving, and I want to talk just a little bit about what the charitable giving and time that I have donated has given back to me and to those who work with me, and convince you all that you should join me because it's really rewarding. So if you'll indulge me for just a few minutes. There are three things I want to talk about that have made it possible for me to stand up here today, and why I care so much about helping others and giving back. And those three things are a coat, a map, and opportunity. So I'll start with the coat, and I don't know if we can switch to the next slide. So this is me in 7th grade with my best friend, Dana. And it's possible that I had a new coat before I was in 6th grade, but I don't ever remember having one. But I remember this is the coat. This is the first new coat I ever remember having. And when I got this coat, I tell you, I strutted my way to school like I have never strutted before. 2 blocks away from my house, a bird pooped on my coat. So I also learned humility in the same day that I strutted. But I never forgot the feeling that I got from that new coat. The feeling of pride that I had to have something new and shiny, and I have really carried that with me. And so living in Chicago, it's very cold, and I think if you look closely, you might be able to see my first gray hair forming. But in 7th grade, in 8th grade, I still, that feeling of a new coat has stayed with me. And so every year when it comes time for the coat drive, which in Chicago is very important, I take my kids and we go and we buy new coats. And we donate the coats that we have, but we also buy new coats. And the feedback that we get is incredible from people who say, I have never had a new coat. You have changed. My kid can walk into school, or I can walk into a potential job. And so I want to say to all of you whose practices don't lend, it's not as easy to get the pro bono opportunities, right? Because it is very easy to have pro bono opportunities in controversy. It's not as easy in every other kind of practice. Please consider, when you can, buy the new coat. Give the client an opportunity to buy the new coat, and please join me and More Tax Law Group in donating to your local LITC, to TAPS, to JEDI. And today, More Tax Law Group is going to match all of the donations that are made to TAPS and JEDI up to $5,000. And I ask you to please join us. So the next thing I want to talk about is a map, and that's on the next slide. And just very briefly, when I was in college, there's a group of us who would go to Cook County Jail, and anyone who's incarcerated in Cook County Jail is typically arrested, and they couldn't make bail and they're awaiting trial. And there was a program to help people who were incarcerated there to get their GED. And we would go and tutor people to get their GED, and I tutored a woman who, part of getting a GED is learning how to read a map. And she did not know, so we did this map reading exercise, and it was as if a light bulb went off. And she said, I would love to know how to get to Grant Park. I've never been there. Born and raised in Chicago, had never been to Grant Park. Grant Park is where Lollapalooza is held every year. And if you look, it's 8 miles from Cook County Jail to Grant Park, and she had never been there. And we worked through the mapping exercise, but the point that I'm making is it has always stuck with me in my career when someone is both literally and figuratively unable to figure their way out of a situation. And the way that I approach tax problems is trying to understand the roadmap. What is the map? How do I map my way out of this? And then I want to teach my client how to read the map themselves. How can I help you understand how to read a map? Thinking back to that first opportunity that I had to teach someone how to read a map back when I was in college. And the third thing is just opportunities. So the next slide is, I started doing pro bono very early in my career, back when I was at Holland & Knight, which I cannot say enough good things about how supportive that firm was of this practice, and pro bono when I was there. This was the very first motion. Came in at the last minute, as we all do in a calendar call, and I came in and argued. Respondent had filed a motion to dismiss as moot on a levy case because the client had been levied and it was now paid in full. And all David Autry's stories start with, I had a case. All my stories start with, I was very pregnant. I was very pregnant, and I argued on behalf of petitioner. This is my very first argument on a motion to dismiss. I did not win, but Judge Paris was incredibly gracious. But when you do these things pro bono, and my first motion to dismiss argument was this case, pro bono. My first cross, my first opening, my first closing, all pro bono. My first opportunity to, obviously, what Nina Olson giving me the opportunity to brief on behalf of the Center for Taxpayer Rights and the Supreme Court, pro bono. Thank you to my partner, Jana Ziering, for all the hard work that brief is really her brief. But I am incredibly grateful for every opportunity that I've been given, and it all comes back to this section and the people in this room who I have worked with on panels, I have worked with on comment projects. They get to know you, they know your work, and then they want to work with you on a case. And one opportunity leads to the other, and it is because of my pro bono opportunities and my section work that I have gotten the work that pays the bills. And I'm so grateful for all of it. And again, I'm just humbled and honored and want to thank all of you and everybody in the section for the support. Thank you.
You can leave it. You can get it back to us. That was just lovely. Thank you, Gwen. Now to the next item of business. The Distinguished Service Award is the highest honor awarded by the tax section. The award is reserved for individuals who have had a distinguished career in taxation and who have provided an aspirational standard for all tax lawyers to emulate. And it is my honor and pleasure to recognize our 2024 Distinguished Service Award recipient, Richard Dick Lipton. You will find a detailed summary of Dick's career at your table, but I would like to mention some of the highlights before recognizing him for his remarks. Dick was born and raised in Youngstown, Ohio, and had a passion for tax law throughout his education and through his entire career. He received his undergraduate degree from Amherst College and his law degree from the University of Chicago, where he had the great privilege to study with the preeminent tax law scholar Walter Blum. Dick went on to clerk for Judge Cynthia Hall of the U.S. Tax Court, and then to a Chicago law firm where he met Sharon King. And thanks to Sharon's mentorship, Dick was introduced to the meetings of the ABA tax section. And I just want to pause and say, I think all of us can look back to somebody who got us involved in the tax section. It's really to hear people's creation stories of how they came to the tax section. The similarity and the consistency is just amazing, and Dick is no exception to that. He quickly rose in the section to helm various committees and task forces amid the passage of the Tax Reform Act of 1986. In 1990, Dick was elected to the section's council, where he worked closely with long-term executive director of the tax section, Christine Brunswick, who many of us remember so fondly. Together, they were able to establish a measure of financial independence for the tax section from the larger American Bar Association, and that has allowed us over the years to support pro bono initiatives, the Law Student Tax Challenge, and programs that encourage young lawyers to be active in the tax section. Over the years, Dick has served an astounding 34 years as a member of the tax section's council. That is a record like Joe DiMaggio's 56-game hitting streak that is unassailable. Those roles have included serving as chair from 2001 to 2002 and as a delegate to the ABA's House of Delegates from 2005 to 2021. Currently, Dick is distinguished to serve on the American Bar Association's Board of Governors. He has provided valuable knowledge and mentoring to many section leaders, definitely including yours truly. Dick's time in private practice started in corporate tax, but he was soon approached to advise on a partnership tax issue. And again, with impeccable timing, as he was getting into the partnership field, the IRS ruled that LLCs should be taxed as partnerships, greatly expanding and simplifying the use of partnership structures in business transactions. Dick spent the remainder of his career as a partnership tax lawyer, including the last 20 years with Baker & McKenzie, where he has continued to indulge his passion for partnership taxation and the most effective tax planning for his clients. Dick has time and time again demonstrated an intense dedication to the profession and to the drive to change it for the better, as well as to an abiding and sincere interest in the growth and success of this tax section. For this, and for many other reasons, it is my honor and pleasure to recognize Dick. And I will say this: in the history of the world, going back to the beginning of time and going forward to the end of the universe, there will never be a person who has won both the Distinguished Services Award from the tax section and who also has a National Football League Super Bowl championship ring. And that, my friends, is Dick Lipton. Thank you.
I just have to say, completely extemporaneously, I discussed with my wife whether I should wear the Super Bowl ring today, and I didn't. And now I'm feeling really sort of dumb. Oh, well. But at least it's one of the little betterments I had out of representing professional sports franchises and the owners thereof. On top of that, I not only have a Super Bowl ring, I have a Stanley Cup ring as too. So, folks, you may want to reconsider your clients and your careers. There are other possibilities. I am, like Gwen, very honored to be receiving this award. I think back and knew quite well a lot of the prior recipients, people like Jack Nolan, Jim Holden, Marty Ginsburg, Ken Gideon, Larry Gibbs, Jerry Cohn. These were the people that when I was a younger lawyer, I looked up to. And I am exceedingly honored and humbled to be included in a group with them. There are a few people I want to thank, of course. I want to start with thanking Baker McKenzie, my firm. They have supported me while I've done all this work involving the American Bar Association. We've got Dan, Maher, Alexandra, Sam, and I especially have to call out Leah. Leah, who's here, has worked her entire career with me, and I can assure you, without her support, I wouldn't be standing here as well. Second, I want to thank all my friends in the ABA, including but not limited to my fellow partnership in real estate junkies. Yes, the word junkie is definitely appropriate. A lot of them are here, and I really can't thank you enough. We could just use a bunch of first names: Bill, Dennis, Ruddy, Chuck, Scott, Pam, Paige, Armando, Larry, Jim, Eric, Lou, Todd, Steve, and too many more to name. You all know who you are. These have become some of my very best friends, and it's so great to be here with you. Most importantly, they've made this a whole lot of fun, and that's the reason we all do this. I want to acknowledge my children who all came in for this: Tom, Ann, Martin, and Tricia, and my daughter-in-law, Sarah. They all flew in for this, and I appreciate it. I would add that the other three in-laws are taking care of my grandkids. That is a far better usage of their time than sitting here, but it was all appropriate. And last, and by far most importantly, I want to thank my wonderful wife, Jane. We'll celebrate our 43rd anniversary later this month. I almost misspoke. Boy, never lived that one down. And many of you know her, and no one knows how she's put up with me that long. I can't express how much I love her and how much her support has meant for me for all these years. I certainly would not be standing here without her love and support. I'm going to keep my remarks brief. I want to make two major points. The first one very much ties in on what Gwen said. My view of involvement in the ABA is very simple. It's get involved, stay involved, and be the change. You need to get involved. And I want to speak to younger lawyers, and I want to speak to the more senior lawyers. On the younger lawyers, as Scott said, if it weren't for Sharon King, I don't know if I would be here. She forced me to come to my first meeting. But once I came to the meeting, I started to get involved in doing projects. And from doing projects, I went on to appear on some programs. And from doing some programs, I started to chair things. And I got to know people. And all of the younger lawyers who are sitting here, I cannot urge you strongly enough to get involved and start doing the work. And as a result of the work, you will get to meet more and more people. They will become your friends. They will become your colleagues. And interestingly, they will even potentially become the sources of your business as time goes on. I know in many law firms, people say only go out and do client promotion. I didn't do that. I use the ABA, and that has been the source of my business over my career, and I'm really happy for that. But just as much as talking to the younger lawyers, I want to talk to the more senior lawyers. Over the last 10 to 20 years, I've seen a very distressing trend that the law firms aren't supporting the younger lawyers to get involved with the ABA. There's more important things in life than billable hours, and long-term career success depends upon getting involved in organizations like this. And it doesn't have to be just this. It could be a state and local bar. It's some other professional organization. It could be doing pro bono work. There are more important things than just doing billable work. And I want all of the older, more senior lawyers to recognize and to get their firms to recognize that this is really an important part of life. And hopefully the success of many of the other lawyers out here, particularly the younger ones, can be ensured by having the older lawyers support them doing more things. And then it's be the change. In organizations, you actually have to sometimes rock the boat. Many of you are, well, I don't think there are many in this room who remember, but back in the 70s and beforehand, this organization always met on this weekend and always met on Mother's Day. It was traditional. When I became vice chair back in '93, I said, and by the way, at that time, my youngest, Tricia, was all of 4 years old. I said there was no way I was going to spend Mother's Day sitting in a conference room in Washington. One, my wife would kill me, and she's nodding her head yes, and two, it made no sense. So in the end, I pushed through a resolution through the council to get rid of Mother's Day meetings. That one passed 24-1, and Dick Shaw, former chair, will never live down his vote against motherhood. The following year, I decided that we really needed to address the financial situation of the section, and I suggested we get sponsorship. It had never been done in the entire American Bar Association, ever. And I suggested to the council that we adopt a sponsorship idea. That idea was voted down 24-1, you know who the one was, and the then chair, Al O'Neill, said, "Over my dead body, will future chairs ever get up at the podium at the plenary and acknowledge sponsors?" Right, Scott? Right. The following year, I came in with a signed sponsorship contract, and it passed the council 24-1. Al was a man of his convictions. The only other change that, I did a number of other things, but the thing I'm actually proudest of, and it relates to the prior honoree, is when I became chair, this section had no pro bono activities. There was no pro bono award, there was no pro bono committee, there was nothing. And the reason the first Janet Spragens Award, or its predecessor, was in 2002. That's when I was chair, and I insisted that, again, there was more than just practice. There was pro bono. So I'm really proud of that. Things need to change. If you take a look at it, the meeting format, Scott was addressing the way times are going to change. I think it's really important for everybody to give it a chance, because some of these changes are necessary long-term, and we've changed things over the decades. The second thing I want to talk about very briefly is that tax lawyers, and I'm a practitioner, I'm a planner, need to stand up for what they believe in. A long time ago, I wrote an article which I based on one of my favorite comic strip characters, Pogo. And in that article, which I entitled, "We Have Met the Enemy and He Is Us," I pointed out that a lot of tax lawyers, and I hate to say it, also tax accountants, weren't willing to proceed until they got guidance from the Internal Revenue Service. They weren't ever willing to really think through a problem, think through the regs and the law, and say, this is the right answer, and trust your own judgment. And when I wrote that, what struck me is the lawyers, advisors need to believe in themselves and believe in their judgment. And when there is no guidance on an issue, you don't need to be frozen. Just think the problem through, whether you're a planner or a litigator, and come to the right answer. As another prior winner of this award, Carl Ferguson, said in his Griswold lecture, how will a judge rule? Think through what's the right answer, and don't just wait to get guidance from the Internal Revenue Service. When I train lawyers in my firm, which I've done for many, many years, I point out there is a rule for this. It's called the rule of the treasure of the Sierra Madre. Guidance, guidance. We don't need no stinking guidance. The second corollary of this rule comes in dealing with the government. I've always tried to be respectful of the government, but lawyers, and particularly the section and tax lawyers, need to stand up for what they believe is right. Too often, we don't tell the government bluntly enough what they're doing is not misguided or just plain wrong. The other day, I attended a session here where a representative of the government said, this is what we're going to propose, and we don't want you to tell us it's wrong, just give us constructive suggestions. Well, I'm sorry. Telling you it's wrong is constructive when it's wrong. As those of you who've gotten to know me well, I have never been subtle in making these types of comments to our friends in the government, as Pam so well put it in the write-up. I'm just hoping that future lawyers will carry on that tradition. I always viewed myself as the loyal opposition. I never served in government other than as a tax court clerk, and I'm happy of that because it gave me the ability to stand back, look at tax situations, take into account what's the right answer, and then try to advocate to get there. So I'm very glad to have spent my entire career working in the tax area, but most importantly, working with the tax section and all my friends in the tax section. Thank you very much.
I couldn't endorse more wholeheartedly Dick's comments about getting active in the section and about the value of section participation that our law firm leaders should recognize. So just quickly now, I would like to extend some thank you and express some gratitude. First of all, the tax section is blessed in so many ways by an incredibly capable and professional staff. And our staff has worked so very hard to put this meeting on, to make benefits available to our members, and to get the section going and fulfilling all of its missions. And so first of all, I would like us to express our gratitude and appreciation for the staff. I'd like the staff to stand up, wave wherever you are. Next, I want to recognize our committee leaders, our speakers, and our leadership council for the tremendous work in putting together this meeting, the informative CLE panels, the business meetings, and the networking events. Thank you all for your hard work. I would especially like to thank our outgoing committee chairs who will complete their terms next month. If you are an outgoing committee chair, please stand up so we can thank you. These members have dedicated a tremendous amount of their time and talents to the tax section and have built vibrant communities within their areas of tax expertise. Your commitment is deeply appreciated, and we hope you will continue your involvement with the section in other forums. This year, we also have a large number of officers and council directors completing their terms. As chair of the section, with my colleagues in leadership, we could not have completed our duties without a strong team on council and in leadership. These individuals have guided the section through challenging situations and come up with innovative ways to move the section forward into the future with humor, joy, patience, and care. In one case, one of our vice chairs started a new position, and she has set an amazing precedent and big shoes to fill for the way that position is run going down the road. So your collective wisdom and talents are appreciated and will be missed. I would like to recognize and ask you to stand Caroline Cirolo, the first vice chair for Membership, Diversity, and Inclusion. Roberta Mann, the vice chair for Publications. Mary McNulty, the Vice Chair for Committee Operations. David Wheat, who is not here, but David Wheat, Vice Chair for Administration. And Lisa Zarlenga, the Vice Chair for Government Relations. I would also like to recognize our departing council directors, John Colvin, Rachel Kleinberg, Rob Longman, Susan Morgenstern, and Vanessa Scott. If you are all here, if any of you are here, please stand up so we can express our appreciation. Maybe nobody's here. I would also like to recognize Scott Levine, who ended his tenure as council director a bit early to take an opportunity at Treasury, where he is serving the country. So let us thank all of these people for their leadership in the section. And now there's an awkward moment where I step aside.
And so now I'm Alice Abreu. I am the chair-elect of the tax section, and I am here to present Scott with this award.
Thank you very much.
And to thank Scott for your incredible service to the section as the chair this past year. It's been a real privilege to come behind you and to learn from you, and I hope I can amplify what you have achieved during your term as chair and continue your legacy of leadership with creativity and a steady hand. So thank you very much.
Thank you, Alice. Thank you very much. Thank you, Alice. Believe me, the section will be in great hands beginning in August when Alice takes over as chair. I also want to thank the staff and the leadership that I mentioned, all of our leaders, all of our vice chairs, all of our council directors, committee officers, and all of our members for making this organization such a vibrant, fun place to participate in and to have so many productive and important missions that we aim at completing for the tax section and for the tax bar. It's what makes us a vibrant and dynamic community, and I'm very, very honored to have served as your chair. So I now want to move to our keynote panel, and I would like to thank Roberta Mann, our Vice Chair for Publications on our Leadership Council, for putting together this outstanding and timely panel discussion on the impact of taxation on climate change. Roberta will introduce her fellow panelists, she will moderate, and I will pass the podium and the stage on to them.
Alice next to you, and okay. Oh, my mic is on. Yay! All right. So I thank all of you for being here, even those of you who maybe are not really steeped in the role of tax in saving the climate. And I should also say I'm very inspired by the other presentations that we've heard today. And I really think that you could consider using the tax system to save the planet as another sort of pro bono activity. So that's what we're going to talk about today. And so to my immediate left is Seth Hanlon. And I'm going to credit Scott for really kicking this off because Scott knows Seth. And Seth serves as the Deputy Assistant Secretary for Tax and Climate Policy in Treasury's Office of Tax Policy. Many people have said to me, we didn't even know there was such a thing, but I'm very glad that you are. He was previously a senior fellow at the Center for American Progress, focusing on tax and economic policy. From 2015 to 2017, he served as special assistant to the president for economic policy at the White House National Economic Council, where he coordinated the Obama administration's tax policy. He's also served as senior tax counsel for the House Budget Committee Democratic staff and as tax counsel for Senator Debbie Stabenow, who is a senior finance committee member. And he was previously an associate attorney at Kaplan and Drysdale, where he advised corporations, individuals, and nonprofit organizations on tax law. And then to his immediate right is Alice Lynn, and Alice Lynn is Senior Tax Policy Advisor for the Senate Finance Committee, Democratic staff, under the leadership of my personal senator, Ron Wyden. She handles energy and infrastructure tax, housing tax, general business credits, and certain excise taxes, among other individual and business topics. Prior to joining finance, she worked for the House Ways and Means Committee. In that capacity, she worked on major legislation, including COVID relief legislation and the American Rescue Plan, and she led the committee's work on the clean energy tax provisions of the Inflation Reduction Act. And before that, she worked for the Joint Economic Committee and for Representative Mike Honda. And last but certainly not least is Amish Shah, my friend, and he is a tax partner at Holland & Knight's Washington, D.C. office, and he represents clients in the energy sector, advising them with respect to all tax energy concepts. And this is like way too long, so I'm not going to read all this. He also has been a past chair of the Energy and Environmental Tax Committee. And those of us who are interested in these topics have known him for a long time. So we really have a lot of perspectives on this panel. We have Treasury, we have the Hill, and we have practitioners. So I'm just going to I had just another couple things that I thought about as I was listening to the speakers. And I don't know, Dick, you might have demoralized our speakers just a tiny bit. But I do want to endorse your view of be the change. And I think this panel is definitely instrumental in being the change, not only in tax policy, but also in climate policy. And also, I will just say that if the government didn't give us guidance, Dick, what would you disagree with? So we will kick it off. I've got a few prepared questions that we've all been thinking about just a little bit. So we're really going to focus on recent legislation, and of course that is the Inflation Reduction Act, which has been called the largest climate bill in US history. So for my panelists, and I want each of you to think about this, focusing on those provisions of the IRA that have climate impact, which provisions constitute the most significant changes from prior law, and what challenges and opportunities do those changes create? And I'm going to start with Alice because you know, she's on the legislative side, and then we'll move to regulatory and practitioner. Go ahead.
Yeah, absolutely. I mean, Inflation Reduction Act's clean energy provisions, but in particular the clean energy tax provisions, were obviously very driven by climate. There have been a number of reasons why we've had energy tax provisions in the past, from you know, domestic independence, from foreign energy sources to energy prices and security. But I think what really motivated the Inflation Reduction Act at the top of it was how are we going to meet our global climate commitments, and what role is tax going to play in that? So when we had a budget reconciliation bill, we knew that tax was going to be the biggest chunk of that, and ended up being, you know, around 3/4 or more of the climate investments in the bill. When I think about the biggest movers, right, the most significant is that we got to long-term policy. Prior to the Inflation Reduction Act, we were moving in 1 to 2 year extensions of a lot of our major provisions, including the investment tax credit and the production tax credit, and it's just very difficult, I'm sure Amish can attest to, for businesses to be able to plan when you are looking at 1 to 2 year extensions in tax policy. So the biggest thing, I think, was just a long-term policy that businesses could rely on to make decisions to go to financing, and really just it's the scope of the bill. We touched, I think, almost every code section that already existed, created a bunch of new ones, which Seth has had to deal with, but also impacted almost every sector of the energy sector, right? So not only power, but transportation, and even provisions that touch on kind of industrial emissions. So it's really just this kind of very broad and large undertaking.
So Seth, I think that was a perfect handoff for you. What challenges and opportunities do these provisions
Yeah, thanks.
pose?
And, I'd be remiss not to start out just by thanking Scott for bringing me here. He was my first boss in the tax world, as you alluded to, so really grateful. So yeah, challenges and opportunities. I mean, I think on the opportunity side, just to give the sort of start at the big picture. I mean, it's really the opportunity to meet our national climate goals, and this law has really put those within reach in a way that requires much more much more investment, much more policy changes at the federal and state level will be needed to get there. But the law really makes it. Makes it much more of a real possibility. Our national goal, the president's goal, is to get to between 50-52% below 2005 emissions levels by the end of this decade, on the way to net zero by 2050. And the law, we were headed somewhere around 27 or 30% before the law, and now it's projected around 40%. There's obviously there's lots of uncertainty and many different estimates, but for one single enactment to do that is really amazing. And then to think that the most important part of it is tax is kind of even more amazing to think, and well, it's exciting for a tax person like me. But anyway, so in terms of and then the challenges. And I think for opportunities, we're already seeing the impact of, I mean, I would totally agree with Alice, the long-term policy certainty, of the PTC and ITC. And then we're already seeing, very dramatically, the impact of the manufacturing incentives, like 45X and others, on, domestic clean energy manufacturing, battery manufacturing. So anyway, lots of opportunities. There's definitely lots to talk about. On the challenges, I mean, so there's, as Alice mentioned, So there's 20 different separate tax incentives that are created or modified. That doesn't include the bonus provisions, and that doesn't include elective pay and transferability, the new credit monetization mechanisms. And so there's just an enormous need for certainty, clarity and certainty around those provisions, which is both like an enormous guidance project for Treasury and IRS, and then also it's been a huge kind of behind the scenes. The thing that I've come to appreciate is just the operational effort that has gone into making this law work on the IRS side, and they've just done a fantastic job. So we've issued 64 pieces of guidance so far since IRA passed, but there's a ton more to do, and so we're kind of working overtime.
And I think of 3 just in the last couple weeks.
Yeah, 4 in the last couple of weeks.
4 in the last couple. I had the 6418 regs, some guidance
40B.
on 45V, and just recently graphite flexibility for 30D. So what was the 4th one?
Oh, there was Sustainable Aviation Fuel Notice,
Oh, that
and then the 48C,
round
the second round of the 48C, guidance on the second round of the 48C Advanced Energy Project credit that was last Friday.
Yep, so keeping you very busy and the folks at the IRS as well, but also keeping practitioners busy in responding to this guidance and also responding to the legislation. So Amish, please.
No, it really has, for all the reasons that Seth and Alice were talking about. I mean, I think there are a lot of us who do this who haven't slept very well since July 27th at 10 p.m. when the legislative language dropped. Remember it well. But part of it is, in terms of one of the big things that's new here is these technology neutral tax credits. So, for the last few decades, we've been working in an environment where solar was incentivized, or wind, or certain specific clean fuels were incentivized. And there were very specific technologies. And now we're in an environment where, especially going forward, the code isn't incentivizing particular technologies, or incentivizing technologies that are carbon neutral, carbon negative technologies. And so what this is really doing is it's allowing a lot of the existing technologies that we know about to continue to be incentivized, but it's bringing in lots of new and novel technologies. And so we're spending a lot of time with clients trying to understand both things that we've never seen before. So they'll tell us there's a box and there's all of this stuff in it, and we've got to figure out how it's producing some sort of a clean energy product. So we're working with a lot of engineers and chemists and others to figure this out. And then obviously a lot of it is then trying to talk to Seth and Alice and folks at IRS and so many others about all of this to make sure that we've got all of the right guidance to make all of this work. And we're also seeing the combination of technologies. And so before, someone would come to us and say, I've got a solar project, or I've got a wind project. And now it's, I've got a solar project and a wind project, and they're going to feed into a hydrogen project, and the hydrogen is going to produce a clean fuel, and we're going to add some carbon capture and sequestration. Tell me about the tax rules. And that's when
which we made very easy.
So despite what Dick said, more guidance, please.
So, and of course, one of the big significant changes from prior law, and we've had energy tax credits before. They've been on and off since the 70s, actually. But before that Inflation Reduction Act, it was a complicated mechanism to share the benefits of those credits with other investors, commonly called tax equity investors. But now we have direct pay and transferability. And so I've got questions for each of you in different ways. So for Alice, can you tell us about the congressional intent behind direct pay and transferability?
Yeah, absolutely. And I should have said earlier, all views are mine alone, do not reflect anything of Chairman Wyden or any members of the committee. So standard disclaimer, please don't get me fired. But direct pay and transferability, or elective pay, was, I think, a very key part of the Inflation Reduction Act. I think many of you know that the tax equity market was and continues to be very instrumental to a number of projects, but specifically in solar, wind, carbon capture, and The historic tax equity market has always been chronically kind of undersupplied, and even those, and many were unable to access tax equity given the high level of transaction costs, and so you needed a project of a kind of certain maturity and certain size. And as we were about to really turbocharge all of our energy credits and add a bunch of new ones in, we knew that this would put tremendous pressure on the existing tax equity market. So we were looking at ways to inject additional liquidity, and the two that we ended up with in the final bill were elective pay or direct pay for mostly tax exempts, with some exceptions, tax exempts in state and local governments, and transferability for most other taxpayers. And both of these provisions in tandem were supposed to ensure that a limited tax equity supply wouldn't be the barrier to the deployment of these credits, the take up of these credits, and ultimately achieving the climate goals and the other goals of the legislation.
Okay, and Seth, of course, you've had the responsibility, you and the others at Treasury and at the IRS, of writing guidance all the time. So what issues have come up in creating guidance for direct pay and transferability? And we recognize that all guidance projects require balancing between congressional intent and administrability concerns. So can you speak to that?
Sure, definitely. I think so first there's the guidance project, but then there's also the kind of operational and, action in terms of putting these provisions into effect and getting the word out about them, because they really are kind of, paradigm shifting provisions to, extend tax incentives to entities and people that just weren't in this world before of clean energy investment. The main issues I think on the elective pay side was, we really wanted to clarify what types of entities are eligible for elective pay, and I think we had issued final regulations in March that a large part was aimed at doing that and clarifying that like agencies and instrumentalities of governments are included. And then on the transferability side, we issued final regs the week before this one. Yeah. And I think our main goal there was really like creating as much certainty as we can, certainty and predictability as we can, so that the parties, these markets can develop and parties can contract to allocate risk as long as we have clear rules about where those risks are and how the rules work. And so I think the market's developing faster, very fast, and hopefully the final regulations will give that a further boost. There's more, we have more work to do. So just one thing, we're still in rulemaking on an aspect of relating to co-ownership arrangements between elective pay eligible entities and others, or only elective pay eligible entities. For how they can enter into co-ownership arrangements and still benefit from elective pay. So we have proposed rules relating to the Subchapter K election. The comment period runs through this coming week. And then a lot more just questions to answer. And then just to highlight on the operational side, we created a whole IRA implementation office within Treasury. And in addition to the IRS modernization effort, one of their major undertakings is essentially getting the word out about elective pay in particular. Because if you think about the scope of entities that are newly eligible for what were have been business tax credits, it's, all levels of government and all, types of tax exempts, right? And
So tribal governments as well.
Tribal governments as well, yep. And people just don't know, so, and this government finance officers, are still kind of learning, and then they're accustomed to sort of applying for grants and loans where you have to apply on the front end, and they kind of, are still kind of learning this paradigm. So we just announced an initiative, Secretary Yellen announced an initiative to, we're partnering with 150 cities across the country to, hold events, with local officials to spread the word about these very valuable opportunities. And I think that's another way where the bar, we think about the bar's role and pro bono efforts. There's certainly lots of entities that now have opportunities to really help drive the clean energy transition and benefit, but are going to need technical assistance, regardless of how clear our guidance is, which is obviously our goal.
Yeah, I want to understand what Seth just said, since I think it's really unique that Treasury has taken this very proactive implementation approach that I think really starts at the Secretary, but also the IRS, because elective pay and transferability have a pre-registration, pre-filing requirement, has done office hours and user guides in a way that I think is very thoughtful.
And of course, Amish and you and other practitioners are really on the front lines of trying to work with this guidance and even before the guidance. So I want to ask you, how have these additional flexibilities, how have they impacted your practice? And are you still providing partnership structuring for your clients? And
Yeah, I mean, the transactional work around this has been enormous already. And, as Seth said, I mean, word is just starting to get out. It's almost a little scary to me when word actually gets out to everyone about, this opportunity here that a lot of folks have. And so for folks who aren't kind of familiar with all of this, the big issue here is that we have a lot of developers who build these projects and they're entitled to tens or hundreds of millions of dollars of tax credits. And these are non-refundable tax credits, and so they often can't use the tax credits themselves. And so historically, as Alice was saying, we had tax equity markets where we had tax equity investors come in, but those were people who were looking at grade A projects, who had built up teams generally to evaluate these projects, and there was a limited pool of tax equity investors. And so now with the transfer provisions, you can really just sell tax credits, and you can sell them. And so what we're seeing right now, and this is why it's becoming so huge, is previously we had tax equity investors who were in this space, they knew this space. But now we have buyers of tax credits who have never seen an energy tax credit in their life, and they're hearing about this opportunity to effectively just lower their effective tax rate. And so they're buying tax credits, and the price of the tax credit depends on a number of factors. But oftentimes it's somewhere in the 90 to 96 cent range. And so, and we're seeing clients buying, we're involved, I was in the library before this, dealing with this. I mean, this is kind of an everyday thing. But people are buying hundreds of millions of dollars of tax credits, and they're buying them at somewhere, 90 to 96 cents on the dollar, sometimes lower, sometimes a little bit higher. And so there's just enormous excitement about this. And this market just exploded when the proposed regulations came out. I think it was in June of last year, and that's a testament to Seth and his team and the folks at the IRS, because when that guidance came out, it was very well done, and it gave the market really great comfort about moving forward with these transactions. And so, and one thing just to, for Alice and Seth and the folks at the IRS, the thing that's been great about this is the stakeholder meetings they've been holding, the opportunities to talk about the issues we're all seeing to try and get this guidance right. And I know folks are working really hard to get all of this guidance right. And I think, by and large, there's been a lot of guidance that's come out. We're all trying to process it, and there's a lot of dialogue. But so lots of transfer transactions. On direct pay, that allows tax exempts, munis, electric co-ops, Native American tribes to build and invest in renewable energy infrastructure and go to the government, go to the IRS, and just get a cash payment. And again, that's opening up a huge market. There's a lot of education that needs to be done. I know a lot of people are doing that, Seth, Treasury included. And so that's gonna kick up as well. But again, they can build these projects and get cash. We are still seeing the old tried and true tax equity structures, including the partnership flip. They still exist. It's, we now have 3 ways to monetize tax credits, whereas we had 1 before. And so you've got to look to see which one is the most beneficial. But, a lot of those were the partnership flip structures, or the P flips. But now we're seeing partnership flips actually combined with transfers. So you have a partnership flip, and then we're selling, some or all of the tax credits out of those partnership flips to corporates that have, again, probably many of them have never dealt with the tax credit before. And so it allows just a lot of players in this space, and those are, what you may hear called T-flips now. So a lot of work in this area.
Yeah, and I think when we were chatting before, Amish, you mentioned, of course, we're really focusing on the IRA provisions, but there's depreciation as well, and I think you were telling me that really that's the only way to monetize that really is through a partnership flip. So
Right.
they're still quite viable because there's a lot of moving parts to these transactions.
That's right. And that's right. And so to utilize the depreciation, you can't direct pay. Transferability doesn't help to utilize the depreciation benefit, which has been, again, obviously a huge driver of the capital stack in these projects. And so, some clients can use depreciation but not the tax credits, and that's great. And others are engaging in variations of these structures to be able to use both depreciation and the tax credits. But again, the big news to me is just all of the entrants into the market for this, including clients, and all sorts of corporates who just really want to reduce their effective tax rate, who are coming to us and trying to get educated on this. And again, just the tip of the iceberg so far.
Yeah, I think that's right. And the tip of the iceberg, that's sort of an interesting point, which I'm just going to make kind of as an aside, that the initial estimate from JCT for these provisions, these climate provisions, was $271 billion. And now, JCT has moved that up a bit, I believe, to something like $330 billion. But other independent researchers have put these, the cost of these credits over 10 years up to $800 billion. So they're not capped. So, and you can think about that in two ways. You can think, oh my gosh, the budget impact is just going to be amazing. But I think about it that this is really showing that these can have a huge climate impact. And I will talk more about that later a little bit. I'm going to ask you guys about that, but that just reminded me of that particular fact. So,
and I think actually one of the most significant places where JCT has revised their score is on the 45X credit. So it's the advanced manufacturing production tax credit. When you see all of these amazing kind of manufacturing investment statistics all over the country, right? Hundreds of billions of dollars of manufacturing announcements. I think that's where the law is working better than expected.
Yeah, and some of the independent researchers have said that really a large part of their economic analysis actually has to do with carbon sequestration, 45Q. But I want to talk about another change that is quite significant with the IRA provisions, and that is the bonuses for meeting fair labor standards, for locating facilities in energy communities, and some domestic content requirements, of course, very famously in the EV credits. So I would like to get all of your viewpoints on maybe the congressional purpose for that, and also thinking about what is the broader impact of these bonus provisions on our tax system and really on the economy as a whole. And you can start, Seth.
Sure. I think the bonus provisions are really key. They're certainly key to the passage of the law. This is not just a climate law, but a lot of economic opportunity throughout the country. I think one of the more striking things, obviously, it's early yet, and we're gonna, there's gonna have to be a lot more analysis and research about the law's actual impact. But in terms of where the law is creating opportunity, our Treasury's Office of Economic Policy has looked at sort of before and after IRA announcements of investments, and has seen that the investments they're up in clean energy and manufacturing have had a burst everywhere, but most pronounced in the energy communities, which are the areas in short that are have a sort of historic
that had facilities with fossil energy and a lot of potential, frankly, for human health concerns in those facilities. So moving clean energy into those communities can have a really broad benefit, I think, societally.
Yep. Yeah, definitely. And So I think we're seeing the impact. I mean, most of the investment is, generally, and this is part of a bigger President's Invest in America agenda, but there's just a disproportionate amount of investment in the places where that have higher than average unemployment, lower than average college attainment rates. And so, this law is really spreading the benefits of economic growth in a way that hasn't happened over the last several decades.
Yeah. So Alice, what did you hear when this law was being considered about these provisions, and what were the?
Yeah, I mean, I think it works together with what Amish was saying, right, about how the tech-neutral provisions. On one hand, the law is saying, we are now restructuring our incentives around something that is very explicit and clear, which is reducing our carbon emissions. But at the same time, our members, both in terms of getting the large coalition to pass the bill, but also in terms of just the very strong policy goals that they had, wanted to ensure that it was, as Seth had said, we were not only accomplishing our climate goals, we were also ensuring that we were building a sustainable transition for the workers that work on these projects, for the communities, so that these investments are distributed in an equitable way for communities that need to transition from fossil fuels, or from low-income communities that historically haven't had that type of capital investment. So when I think about the bonuses, some place-based policy is not new to the tax code. We have the new markets tax credit, there were opportunity zones, enterprise zones. There have certainly been a number of times where we've tried to target tax incentives based on geography. But it took a lot of creativity to put some of the prevailing wage and apprenticeships requirements or domestic content requirements in, and especially in a context where we had arcane Senate budget rules that meant that we could provide much less direction in the statute than I'm sure Seth and his team would have liked. So that's the reason that I'm sure Amish is going to tell you that more guidance is necessary in order for taxpayers to fully take advantage of these opportunities. But it's, I think, been incredible to see, as Seth mentioned, that there's already kind of data to show that some of these incentives are working.
And you're absolutely right. This is not new to have place-based subsidies in the tax code. And you mentioned the qualified opportunity zones. And so there certainly has been a lot of criticism of the way those have functioned. And I get the sense, and I'd love to hear your views on this, that the provisions in the Inflation Reduction Act maybe were a little bit more thoughtful about how those would work.
Well, so the low-income communities bonus, for example, I think one of the ways that I was thinking about it was thinking of some of the lessons learned from opportunity zones, and how, because I think a lot of these communities in non-tax energy are used to grants and loans, right, and programs where you have a lot of discretion on part of the government agency to ensure that the policy purpose is met. As we saw in opportunity zones, right, where you have a rule and then everybody can take advantage of that rule. So you have to be very careful what that rule is. So a lot of people have asked me, why is there an allocated credit for low-income communities and not for other things, right? And I think it was really thinking about the experience of opportunity zones and how difficult it is in order to thoughtfully design a set of rules that achieves the policy purpose that led to this sort of, I think, more creative approach.
Yeah. So, Amish, are your clients taking advantage of these bonus provisions?
Absolutely. I mean, this was intended to drive behavior, and it is driving behavior. Because if I look at like an investment tax credit, for example, it's based on the percentage of your capital cost for the project. And so it starts at 6%. If you pay prevailing wages and you utilize apprentices, you go from 6 to 30. And we don't know a single project out there that isn't trying to get to at least 30% ITC, which means they are all, if you didn't meet an exception for beginning construction, they're all going to pay prevailing wages based on Davis-Bacon. They're going to use apprentices and build our workforce in the US to build these projects. And then once you get from 30, you can actually get all the way up to 70%. And it's going to be a combination of all of these things that we've talked about here. And so if you build an energy community, you get an additional 10%. So you can go from 30 to 40. Again, you don't have to do all of these, but you can go from 30 to 40%, right? And again, Treasurer and Iris did a great job. They put out a map, and people are looking at that map and saying, I want to build here in this community so I can get an additional 10%. And it's worked. It's worked well, and it's a very clear, easy guidance. Domestic content, again, it's working on both sides. So these rules, Alice was talking about the manufacturing credits. And so on the supply side, we're seeing a huge number of companies looking to build manufacturing facilities in the US to manufacture clean energy components. And for that, they are entitled to tax credits. When you're actually building the renewable energy facility, if you use domestic content in your facility, then you can get 10% additional tax credit. There is a lot of work around the domestic content issue right now. We've gotten some guidance so far. I think additional guidance will be very, very helpful in kind of unlocking the benefits of the domestic content bonus. But I would tell you, people are excited about we're spending, we've got teams of people really just spending a lot of time analyzing domestic content and making sure we meet, or we think we meet the requirements. And then low-income bonus, obviously, we've a community bonus. It's an allocation process, and so again, it's people are looking for the allocation, but it is these are the conversations we're having spending a lot of time on every day, which is how do we get these higher amounts in these bonus tax credits. So I think it's doing exactly what I think Congress intended to do, which is driving that sort of behavior.
Well, that's good news, I think. So turning sort of more to a kind of a perspective type question. So clean energy tax subsidies have generally been temporary. These are also, many of them are temporary, but they're temporary over a longer time frame than what we've seen in the past. And many of us who have studied this space have looked at charts for example, the wind production tax credit, and looking at facilities that were being built, and the graph goes up and down, looking at the proposed termination of those credits, and then which were sometimes retroactively renewed. So what are the pros and cons? Well, and also I think I talked a little bit about maybe a potential con of these tax credits in that they are uncapped. So the cost to the fisc, of course, was predicted and may change, may increase given the increased take-up. So what are the pros and cons of temporary subsidies? I'm going to start with Amish because he's dealt with those over the years. And we'll just consider the Inflation Reduction Act as temporary, but over a long term. So in the past, it was much shorter term.
Yeah, in the past, we often had 1 or 2 year extensions. We had ramp downs of the tax credits. And as Roberta said, sometimes the tax credits expired and were renewed 2 years retroactively. And that's a challenge in terms of long-term planning. And so I think we saw a lot of the same sort of facilities being built over. So when we first, when I look back at kind of 04 and 05, we were seeing, a lot of biomass, a lot more of a variety of types of projects. And that quickly kind of moved to doing mostly solar and wind projects on the clean energy production side. And then on the clean fuel side, really ethanol, biodiesel, and some other alternative fuels. And it was kind of a limited scope of these. Because these are now long-term, the credits, most of the credits don't really expire until at least 2033, and then they start to ramp down from there. There's one for clean fuels that has a shorter life, but I think there's a hope that it'll get extended. But because of this kind of long-term scope, we're seeing a huge number of companies come into this space. I mean, there are, we're getting calls from new clients left and right who are just getting into this space and want to build projects because they know they've got this long period over which to develop projects. And going back to something I said before, what we're seeing is a lot of novel technology. They now have the time to develop new technologies, make sure it's incentivized, and then ramp up those technologies and be incentivized to do that over a long period of time. So I think it's really just driving a lot of new technology and just incredibly amazing technology that really smart people are really developing and coming up with.
So Alice, Amish is talking about the pros, but are there some pros to having shorter timeframes and what about the cons?
Yeah, I mean, I think the main thing that Congress thinks about is that anytime you have a policy that expires, it's an opportunity to reevaluate the policy. That's why I think, not in the tax base, but you often have on the spending side a lot of reauthorizations, because it provides an opportunity for Congress to think about whether or not the policy needs changing. We create a lot of new things in the IRA. I think, hopefully all of those things work smoothly, but I think when you have shorter term policy, it is an opportunity to think about whether things are working correctly. And I think that's just also speaks to the challenge of creating good long-term policy. Again, I hope we did a good job, but I think there was a lot of thought that went into both the structure of the tech neutral credits, and as Amish mentioned, that the ITC, PTC can have a longer termination date based on emissions targets for the power sector, but also trying to future-proof as best we can while there are moving pieces outside the tax base, right? So the energy efficiency incentives, for example, that were updated in 25C and 45L, and previously 179D in a prior legislation. Those are all tied to these kind of government or kind of consensus-based efficiency or building standards. And as those standards evolve, it also dramatically affects the tax credit. So just trying to anticipate what those changes would be, but none of us have a magic 8-ball that will tell us what will happen to those pieces 20 years from now.
Yeah, well, technology, of course, moves along. And Seth, what about the pros and cons from that?
I mean, I think I just having, I don't know if this is from the Treasury perspective, but just personally, before having been involved in some of the tax extender fights before IRA, not at Treasury, but that's just a nutty way to make policy. I mean, and having long-term policy certainty is just so important. And then I think Alice alluded to, there's a balance that Congress needs to strike, and then also Treasury and IRS of between specificity, but also long-term nimbleness, right? So that's why Congress passed changed the PTC and one example, changed the PTC and ITC into these technology neutral credits, and there's a lot of other provisions that are based on life cycle analysis, and so I mean I think there's and so there's a lot of ways where the law is designed to evolve with the science, and so that a law like this, it's like have to work hand in hand with the rest of with the real expert agencies, in particular DOE and EPA, but also others, to write rules.
Yeah. Well, I had another really great question, but I see some people are leaving because they probably have flights. But I think we have a few moments, and we could take maybe a few questions if there are questions from the audience.
I have a question. I represent a lot of taxpayers who've been using tax equity investments to conserve land, which has long-term impacts on climate change because these green spaces are opened and preserved in perpetuity. But the IRS has been using a slew of enforcement mechanisms to penalize civilly and even criminally folks that are using tax incentives to affect climate change. And my question is, it seems like there's a real tension. Oh, and in a lot of these cases, by the way, the environmental impact of the preservation is deemed by the IRS to be totally irrelevant. So even if you can show how much carbon is, carbon production is going to be saved in perpetuity, that's treated as kind of irrelevant to the question of whether or not they're entitled to the tax incentive. So my question is, there's like a real tension between Congress's goal to try and combat climate change through tax incentives and the IRS's goal to maximize tax revenue. So how should I tell taxpayers to deal with that tension?
Well, I'm not sure that this is quite the right panel for that question. But if anyone would like to try to field that's fine.
I think I'm going to stay in my lane, not focus on, probably prudent
Okay.
not to, for me not to talk about IRS enforcement practices, but I appreciate it.
Yeah, you've given me a great opportunity, though, because what I wanted to do, actually, is if you are interested in this topic and interested in, for that matter, conservation easements and that sort of topic, the American Tax Policy Institute is holding a symposium in New York at Pace Plaza. They're Pace University's downtown campus. You don't have to go to White Plains. And it's going to be next year, March 20 through 22nd. And it is on tax law, environment, and climate change. And we are going to have a panel that is going to cover conservation easements as well. So I encourage you to go to that. They're a great organization, and it's going to be a really good symposium as well. And I hope we can get you guys to go, too. So that, I think, is all I have, and we are getting the hook, so.
I want to thank our panelists for an incredibly interesting and provocative discussion about the unleashing that is going on in the economy with the Inflation Reduction Act. And I want to thank again the staff for their efforts in putting together this meeting. We will see you all online in the fall and in person in February of 2025. Thank you so much for coming.